Let's broaden out this conversation now with David Kostin. I'm pleased to say he is Goldman Sachs chief U.S. equity strategist. He sees the S&P 500 rising to 6,500 by the end of 2025. And I want to get to that target, but we have to start with Nvidia. We were just having this conversation with Caroline about how Barclays, Bank of America has come out and said, this is a macro event. You look at how investors are pricing this in either direction, and it has enormous consequence. How are you thinking about Nvidia? Is it a macro event?
Well, I guess I'll think about it in a couple of ways. First of all, it's certainly a significant event, given it's the largest stock in the market at $3.6 trillion. And when we think about the investment decision that portfolio managers are making, the most consequential decision for the last several years has been how to position, how much of a portfolio to own and allocate to the Magnificent Seven, as we often refer to it. And Nvidia is certainly one of those constituents. And I think the lesson for the last couple of years and looking into calendar 2025 is that the premium growth rate is likely to diminish. What do I mean by that? If you look at the earnings growth for this year, collectively, those 7 stocks, of which Nvidia is one, are expected to have earnings growth of around 30%, a little more than 30%, compared with the other 493 companies with maybe 3%. But that gap is likely to narrow significantly this coming year to probably around 6 percentage points. And as a consequence, our expectation is that the premium returns that we've received, that investors have received over the last couple of years from these biggest stocks, is likely to narrow. Still outperform in next year, but by a much narrower amount. Last couple of years, you've been 63 percentage points outperformance in 2023. Year to date, it's been around 22 percentage points. Maybe it's closer to 7 percentage points next year. So we'll think about it as a broadening of the market, more probable than not, and I think that's one of the consequences. Doesn't mean that the companies aren't going to have great sales, great earnings. Right. It's rather the share prices likely to be more in line with the rest of the market.
Well, I could appreciate, of course, David, that view on earnings. My question is more around what role the stock plays, what role these stocks play. If you have the Magnificent Seven and Tesla, in part trading on Elon Musk's closeness to the president-elect, if you have Nvidia being almost like a haven in some regard, somewhere to hide because you believe in the AI story and maybe the consumer or other parts of that broadening story are weaker, what's the upside risk in your view here that the Magnificent Seven might still stand apart by a large margin from that widening trade?
Well, first of all, our analysis would suggest that collectively these 7 companies trade roughly in line with fair value, as the same as the rest of the 493 companies. You think about that, each company individually, cross-sectionally, how does it compare with its projected or modeled valuation on margins, on sales, some of the fundamental metrics that one looks at in valuing a company would suggest collectively they're basically trading around fair value. That means that it's the relative earnings growth that's likely to drive the relative performance as you look into next year. That relative performance is likely to narrow. In that context, you're likely to get a narrowing of the outperformance. Still outperforming, but by a much smaller amount. That's the point that I was making earlier, that's something that portfolio managers need to think about, because these companies are 30% of the overall index. So obviously very consequential. And when you look at the performance of mutual funds, as an example, 75% of the mutual funds are lagging the benchmark being the S&P 500. The 25% that are doing better than the benchmark, outperforming, are basically an inline weighting in these biggest companies. The underperforming companies or mutual funds have been, less optimally positioned. They've got an underweighted position. And so we think about the best strategy is probably to benchmark these companies, and the better investment alpha opportunities are at the mid-cap level. That's a long-term track record. Mid-cap stocks have tended to do better. They have similar growth rates, not to the biggest stocks, but to the broader market, and they trade at much lower valuations. They're in line with the long-term average. And so I think that is a way of thinking about relative performance. If the goal is to beat a benchmark, the goal is to outperform, well, this is an opportunity set to be broadening of the market for the reasons I mentioned, a narrowing gap in the earnings growth rate.
David, I read The Art of the Deal back in the late 80s when I also had every single Prince album, including the singles and the EPs, on vinyl, and wanted to be a fighter pilot training at Miramar. A lot has changed since then for me. Why are you recommending the book now? You're the second banker I've heard recommend it recently.
Well, look, the lessons learned that at that time, the developer Donald Trump, in 1987, when he published that book, some of the characteristics, some of the observations he made about thinking about business, you can translate over to what does it suggest about the investment environment for calendar 2025, and the observation about, well, thinking big, well, with the idea of what's going to happen with these largest companies. And our observation is that it's going to be still outperforming, but by a narrower amount. Thinking about a portfolio strategy approach, which is when we think about M&A candidates, I think that observation about have lots of deals in the hopper as they are as investors thinking about the best way to play the idea of an increase in merger activity. Well, we have a basket of companies traded on Bloomberg, but basically the idea is what are the companies that are most probable to have a merger in the next year? Well, we're expecting a 25% increase in the number of M&A deals in the coming year. That's about 750 deals greater than $100 million in value. Well, those companies are likely to outperform. In the first Trump administration, this strategy outperformed pretty consistently over that 4-year period of time. When he was in the office, he had a somewhat less activist regulatory environment, and so that's something we're anticipating in the coming year, those stocks to outperform. The other way to think about it would be the idea of companies that are customers are small and medium-sized businesses. This is an important, observation because at the beginning of the first Trump term, you had a huge increase in small business optimism, skyrocketing, and our expectation is you're likely to see an increase in that as well. Well, that leads to more activity, more sales, et cetera. If you are a company, some large companies that are whose customers are in mid-sized businesses, you can think of Yelp, you could think companies like that whose customers are in those areas, they're likely to benefit as well. So there's some strategies, the idea of a broadening of the market. You can think about the M&A strategy. You can think about companies in small, medium-sized customers.